Gold and silver didn't crash. The market simply responded to policy and emotion. Hello, everyone. It's Rick Fronick from Silver and Gold Solutions here in Galena, Illinois. And today's gold and silver stacking series, I wanted to break down what happened with the markets on Friday, January 30th. Okay, now this is everybody was panicking. Everybody's wondering what was going on, but there's specific reasons behind what happened and also what increased the surge of gold, the price of gold over the course of January. And what I'm going to break down in today's short video is some important information as to what happened with the markets, why the dollar surged, and also what people who are saving in the form of silver and gold, the smart stackers, have the opportunity to do right now with everything that's being taking place. Right. So what I'm going to do is I'm going to go ahead and jump into this and this is going to be a short presentation. So this is something I'm going to share a clip on something about the gold markets that it's a clip that I found online and it's something that it should be in the mainstream media, but it's not. So this is very important information that I'm going to share throughout this video. And like I said, I'm going to keep this short and to the point so everybody can get a good analysis of what happened here. So the main reason the markets crashed on Friday was when President Trump's nomination of Kevin Warsh to lead the Federal Reserve. The news, which surfaced on Friday, triggered a strengthening of the U.S. dollar, a rise in Treasury yields, and massive profit taking after the precious metals had reached record highs. I'm going to share an article too here a little bit about this, but too. The investors perceived Kevin Warsh as more hawkish on inflation and monetary discipline than previously anticipated, calming fears that the Fed would aggressively cut interest rates to satisfy the administration. The market reassessed the likelihood of deep rate cuts, which had previously fueled the then current rally. So this is one thing I want everybody to understand. Like with gold and silver markets, it's based on emotion and different things that happen in the news that day. So at different times of the day, you may see things like on Friday where, everybody's, it's being called a market crash. Yes, the market's dropped. Okay. But this is actually kind of a reset, so to speak, which is good. But the thing is to understand is that it's based on emotion. So throughout the day, it can fluctuate real high depending on, buyers and sellers. But that's one thing I want to make sure everybody understands. So if you're looking for uh, real short-term gains, yeah, at certain times you're going to see really great gains, 'cause like we saw in this past week when gold really surged up high, to amazing view was close to 5,500. Um, so this is something where you are able to get short gains, but for the most part, gold and silver, when you're saving in gold and silver, it's a long-term thing. Okay, so it's not something that like you're not doing day trading or something like that, where you're going to necessarily get gains every single day or however you want to do it, but just kind of keep that in mind. So with the surging U.S. dollar, the nomination led to a strong U.S. dollar, making dollar-denominated assets like gold and silver more expensive for international investors, thus reducing the demand. Okay, so that's key. And then profit taking with an overbought market. After a rapid months-long and in some cases week-long rally that saw silver break 45-year highs, investors rushed to lock in profits, leading to a flash crash scenario. So I think that was kind of a good way to describe it, like a flash crash. And with the rise of a new Fed chair seen as dedicated to an orderly monetary approach weakened the argument that precious metals were necessary to hedge against currency devaluation. As a result, silver futures plummeted over 30%, making this the worst day since March 1980, while gold fell approximately 9 to 11%. Okay, so to kind of back this up, I did want to share this little bit from this is an article from courtesy of Money Metals by Mike Mahari. And I'll have this link for this below the video as well, too, if you want to read the full article. The big sell-off likely reflects the view that Warsh won't be quite so prone to cutting interest rates. A higher rate environment is considered a headwind for gold since it is a non-yielding asset. Coupled with algorithms set to sell at specific levels and panic selling as the price dropped, it was a recipe for a big correction. And he says even here, I think the correction itself is healthy, however misguided, because people that are not following the gold and silver markets are, right away when they see something like this in the news, they're saying, well, I'm glad I didn't, buy gold, or I'm glad I didn't buy silver, but they're not getting the full picture. And that's what I'm trying to do here, is share the best information with everybody so you have an informed decision. Okay. And then a little bit further in the article, it says the debt black hole demands easy money. So this kind of falls into what I just shared on the other slide. More significantly, the central bank will likely be forced to cut more deeply because the debt black hole demands it. Quite simply, a new Fed chair isn't going to suddenly erase the massive levels of debt in the global economy. I've been arguing for months that the Federal Reserve is caught in a catch-22. It simultaneously needs to raise rates to battle persistent inflation and cut rates because this debt-riddled bubble economy can't function in a normal rate environment. So it is a catch-22. Warsh might be an inflation hawk, but when the rubber meets the road, he'll do exactly what any central banker would do. He'll almost certainly pick rescuing the economy over holding inflation at bay. So kind of keep this in mind too. And like I said, I will have the link for this article below too if you want to read the full article. And so what I want to do is touch on here real quick. So I always go over the gold and silver ratio because this is so key when you're getting the overall picture of what's happening. Okay, when we started our gold and silver stacking series back on June 21st, gold was at 33.69. Okay, and silver was at 36.02. And at that point, the gold to silver ratio was, it took 93 and a half ounces of silver to equal 1 ounce of gold. So see here, I have key dates since we started this weekly call going back to June 21st. And you see here at the beginning of the year, okay, on January 2nd, gold was at 43.32.90 an ounce, and silver was at 72.91 an ounce. So you see here over the weeks, and it leads into what I'm going to share with the next video clip here about what's key about why the gold markets and everything and silver have been um, basically setting all-time records on a daily basis, so to speak, for the entire month of January. But so you see 43.32, and then January 16th, 45.99, and then you see what silver's doing. Okay, so last week, January 23rd, gold was at 49.86 and silver was at 103.46. So when you look at the gold silver ratio here, going to the beginning, right at January 2nd, it was 59-1, and then it started dropping lower. So like I talked before, that the typical range is the 40 to 60 range over the course of history. So like some people say that eventually it's going to get down to a 7-1 range. So when you think about that, whether the price of gold is at $10,000 an ounce in, what would silver be? Okay, so it's something to kind of keep in mind here that there is that part where they're going to catch up to each other, so to speak. So in this case here, when we closed the markets on Friday, it was at 48.97. So we did go down, but still look here, January 30th compared to January 2nd, you're still at a $500 an ounce profit. Okay, silver 72.91 on January 2nd, it's still 86.30. So people who think that they lost money, if you started saving any time, either at the beginning of the month of January or into last year, you still have a profit. So even though the markets took this basically are basically settling, so to speak, are basically readjusting to what's gonna be happening moving forward. And this next video clip will explain a little bit more about that. But even that, we see we're at 59-1 gold silver ratio at the beginning of the month, and right now we're at 56.7-1. So this is something where you look at the high that gold was at 55.94. So if you got in at 43.32, and when the market was at 55.94 and you sold or whatever, that was a huge difference in a month's time. So that's the importance of, like I said, with the markets based on emotion and the volatility, this is where if you do have certain accounts or certain ways of liquidating your gold and silver, which I'll touch lightly on that at the very end, you do have an opportunity to take advantage of things as the market does have these spikes. But in this case here with silver at 121 was the high, and now we're back down to 86.30. So that's actually still good because we're still way ahead of where we started at the beginning of the month. So what I want to share here, this is a clip. Now this is very important because this guy, Simon Michaud, actually he's a physicist and a PhD. He's a physicist and has a PhD in engineering. And he's actually going to touch on this is something that the media should be talking about or letting people know about, but they're not. And this is the first I heard it. And that's, like I said, I try to filter through all the garbage that's online and the mainstream media and pull out key important points to share with everyone. So in this video, he's going to talk about what the main cause of the spike in gold, okay, over the last 2 weeks. And then also he's going to show some charts as far as, the amount of gold and silver that's being mined and the percentage of actually good quality gold and silver that's being mined. Okay. So there's like two clips from this I'm going to share. Okay. Sorry about this. Like I said, this is live, so I apologize. Let's get, okay. All right. Let's see. Okay. So this is what he's going to touch on first. Okay. Oops.
You are explained by the Basel III banking accord going live in a legally enforceable context. This was a couple of weeks ago. So if I can just share my screen, how do I do that? Yep, share screen.
Okay, I'm gonna skip past this because he's having a little bit trouble here. Okay. All right. There we go. Sorry about this. And this is going live as soon as I finish it, so bear with me.
We've got to do something moment. So they came up with the Basel III banking accord, which basically said we're not allowed to use paper instruments anymore. It was actually adhered to in 2021, as in everyone agreed. It was supposed to go live in January 2023. All right, this is around the time when the Ukraine war kicked off, incidentally. But it's only in the last couple of weeks, we're talking like about maybe 10 days ago, it went live. It's now enforced. What that means is paper gold and paper silver are no longer able to be sold with the same insurance classification, as in, and so all banks were told to get out of silver positions by the end of January, out of all paper positions. So what are they selling? They're selling paper silver. But what if there's more paper silver and paper gold than physical gold? So what are they selling? Okay, so we'll come back to that in a moment because you've got some very interesting information too. I'm going to pull up some charts that my mate Steve St. Angelo of the SRS Sirocco report put together a couple of years ago. He's been doing analysis on this for years. So this is gold. So gold production. What he's showing here is the big three gold producers of the North American system. Even though they're producing more gold, their yield is going down. They're having to work harder and harder and harder to get each ounce of gold. And they're using economies of scale. Here is silver. Again, this is Steve St. Angelo. Steve, if you're watching, thanks, mate. I do appreciate your work. This is the silver industry. And so what he's actually showing over time, yield is going down. What's happening there is grade is decreasing. And they're having to work harder and harder and harder to get each ounce of silver out of the ground. This is mining. Now, here's where it gets interesting. Global historical production back to 1493. Again, Steve St. Angelo. This is a nice data set. What he's showing here, give me a... I'm a simple man. Such things amuse me. All right. Between 1950 and the year 2000, we had peak silver. In fact, 34.57% of all silver mined was pulled out between 1950 and 2000. And since then, it's been declining.
Okay, so what I'm gonna do with is I will share the link to that video below as well if you want to watch the full video. That one's actually like about an hour and 18 minutes, I believe. But I just wanted to share that because that Basel III Accord, okay, that is something that the media should have been talking about. It's something that, but they didn't because that's what's actually made. He said in the last 10 days. So that's why you saw gold and silver just do phenomenal amounts. A lot of it's because they were dumping their paper. Okay. And that's the main thing in that video where he's showing the chart. So is you have all these people doing like typically people are, trading futures, okay, with the silver and gold market. Okay, so it's not actual, even though they make it appear to be physical gold and silver, it's actually not. It's just a promissory note saying, okay, yeah, this is what we're going to trade it at. And then, they don't actually expect people to actually take delivery. But there is something that I did mention in other previous videos that even Andy Scheckman reported this back a couple weeks back where there was one entity that took delivery of 65 million ounces of silver in 1 week. Okay, and nobody knows who that was, but that's somebody, one of the bigger powers that be, whether it's one of the like the federal government or if it's like one of these bigger companies like Tesla or Samsung or one of these companies that actually need it. Somebody went in and actually took physical delivery of that much silver. That's a ton of silver. Okay, so anyways, I wanted to share this short clip from Jim Rickards. And I also have this below too. What's really nice about this video, and I'm not going to share the whole thing, and I'm just going to keep it short, is that he talks about all these things where you see these clickbait items where it's saying, you know, the market's just broke, the LBMA cannot fulfill orders. Part of that is there's some things along those lines that are true that because of some people asking for physical demand. But he also explains too is how these different exchanges can create their own rules at any time. That's one of the caveats between them. So whenever you see those clickbait type things, ignore them. They're just trying to get you to watch the video. That's all they want because they get revenue for people watching the video. So in this case here, I did want to point that out. But if you have the time, this video from Jim is only like a total of 18 minutes, and there's some like AI stuff that rehashes it. But I would encourage you to watch the whole thing too because Jim is he's been the one that's been saying for a long time that gold is going to hit $10,000 an ounce and actually eventually more than that. He actually at one point did a prediction of like, I believe it was 2019. At one point it was 19,000 an ounce and then it was changed to, he bumped it up to $24,000 an ounce. So let's go and watch this. Let's watch a commercial. Sorry about that.
Think silver is going to continue to go up for a number of reasons. Number one, the math example I gave for gold, it applies to silver also. Now, maybe you can use the $10 benchmark instead of a $1,000 benchmark. But again, going from 90 to 100 is 11% versus going from 40 to 50, which is 25%. So those $10 benchmarks, 110, 120, 130, they just get easier. And so I've got silver going to 200 without too much difficulty. Number one. Number two, silver's going to tag along with gold. There's no way gold's going to the levels I expect where silver's not along for the ride. You're not going to have $20,000 gold. We'll get there. Not, it's going to take a while to get to $10,000 gold. We'll get to $20,000 gold, but that's not going to happen without silver going to 200. Silver vaulting into triple digits and gold racing toward.
See, that's what I was talking about as far as it being.
Figures and sound like fantasy.
So what I want to do here is, oops, we'll get back to this. So my main purpose here has been to share with people information that you need to know, okay, that I feel that the mainstream media and a lot of people are not talking about, okay, because there is a ton of noise out there, and I go through a lot of videos and a lot of articles every single week just to try and pull out the stuff that's going to be pertinent, that's going to make a difference and an impact in how you perceive or how you move forward, whether you're going to save in gold and silver or not. But like I said, I've always said, if you I'm not a financial advisor, so if you need to consult a professional or somebody that you have your own personal financial advisor, please do. But at the same time, also keep in mind, everything that's going on. So like when I'll just close out with what Jim was talking about. He did in part of the video, he does the explanation of, gold going from $2,000 an ounce to $4,000 an ounce. That's the biggest jump. But every $1,000 increment after that it takes less effort to get to it. And so he says daily, that's where you'll see at different times daily increases of gold, maybe $100, $200 an ounce, because once it breaks those certain thresholds, like here with the $4,000 threshold, it's, daily, you're going to see that up and down movement. Okay. So what I wanted to do is I wanted to make sure that everybody got that information about the Basel III Accord, because that is actually critical. So that explains why gold and silver took off so much in the last 2 weeks. Okay, and that's something that nobody else touched upon besides Danny from Capital Cosm and Simon Michaud. So I wanted to share that, and then what I want to do here is I want to share with you one thing real quick, and this is something. Whoops. Hang on a minute. Trying to get this to go. Okay, it's not going to pull up. Um, so what I want to share is, okay, I've talked before and I'll have information about this below the video. Okay, so when you get a minute, check it out. It's called fractional gold. You know, I talked about this before with having a sound money account with fractional gold. Now, this is a way that you can actually um, share basically you can actually when markets start taking these spikes or dips, you can with a click of a button, if you are saving, you have sound money wallet and you have your physically saved or the physical gold and silver saved in a vault through the sound money wallet, you whenever the markets take these huge drops or spikes or go up or down, you with a click of a button when you log into your account will see the exact price, spot price of gold and silver at that very second you log into your account. And in this case here on Friday, say, you know, when gold is at 5,500 and you bought it at 4,200 and you wanted to sell, it doesn't matter what time of day, whether it's day or night. And this is what's unique about the Sound Money Vault and having your Sound Money wallet is that you can do this at Saturday at midnight. You don't have to wait for the markets to be open. You can instantaneously convert that gold or silver back to cash and back into your bank account if you wanted to, or you could convert it from gold into silver or vice versa. If you had, you know, 10 ounces of gold and you wanted to convert it to, you know, 1,000 ounces of silver. I'm just saying you could take that denomination and switch it. So you can, that's the benefit of having it. So I'm not sure how everybody here, I mean, if you want to comment below how you're saving in the form of precious metals, if you're doing it physically, that's great because everybody should have some physical gold and silver in their possession. I think that's key. But also at the same time, if you're investing or saving a lot in gold and silver, you may want to consider, like I said, the information about the, you know, Sound Money wallet and being able to purchase in fractional gold. And what's also nice about that as well too is that it'll actually let me see if I can pull this up. I'm not sure why I can't. Um, Let's see. No, I can't. But with that, you can purchase in incremental amounts, whether you want to do $10 at a time, $2 at a time, $10,000 at a time. It gives you that option to do it instantaneously. Okay. So, and it's not something where you have to go through anybody. You can do it all yourself. All the information is tracked and recorded for you, and you can get monthly statements on top of it to show you how much you put into your account and what its current value is. Okay. So I hope everybody got some great insight from this video. I really enjoyed sharing this. This is very important. I hope you took the time to watch this to the end. And if you have any questions, please reach out to me at rick@silverandgoldsolutions.org and I will get back to you as soon as I can. And then also, and a lot of people online, they're not going to say, offer you that. I'm offering that because I want you to have the best information. That's been always been my goal is to share the most important information with you. And if you ever wanted to jump on a private call, please reach out to me as well. And I will definitely get in touch with you as soon as I can. Okay. So thank you for taking the time to watch this video. I hope you got some great insight and we'll see you again next Saturday. Take care.